Well, good morning, everyone. Welcome to Trading a Smaller Account. We have a jam-packed session lined up for you today. I am just back from Atlanta, where I got to meet a lot of you and a lot of people who are new to all of this. So that was really wonderful. But it's good to be back and connecting with all of the usual suspects on a Monday morning. Today, it's not Ford versus Ferrari, although I did really enjoy that movie. It is going to be short put verticals versus long put verticals, short put verticals versus long call verticals, or short verticals versus longs, and when we might want to choose which strategy. So that's going to be kind of our focus today. We also have a number of trades on that we haven't looked at in a hot minute. And so we're going to go and have a quick look at some of those as well. So that's kind of what is on the menu for today. And I hope you'll find it as interesting as I found it to be looking for example setups, etc. If you are not following me in the land of X, I consider this your formal invitation. My handle, Barb Armstrong CS. I'll be posting a bunch of pictures today from the Atlanta event. There are some already up there. We have Scott Thompson with us in the chat today. He's a friend and a fellow coach, now a coaching manager. So we don't get to see him teach as often, which I think is a little bit of a tragedy, but we're hoping that he may grace us with his coaching presence again, someday. But for those of you who've been around for a while, you would know Scott. And to all of you who helped bring this class to life, thank you for being here and for being so participatory in the chat. So to Fingo, who was the first one in, and Sandeep and Jim and DR and Paul and AP514 and Susie Q and Jack and Ray and the rest of the gang. It's great to have you all here. Okay, so let's get through our important information so that we can get right down to business. So know that we do a lot of options in this class, and today's focus is going to be options, although we're going to look at a number of stock positions that we have in our account currently as well. But options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application, which is for educational purposes only, on the thinkorswim desktop platform. It is a brilliant place to learn. Looks like, smells like, feels like real money, but it's not. And so you can become familiar with how to place trades on the platform and make sure that you understand a trading strategy before you consider trading it in a live account. There are some nuances and differences for our topic today. The most important one is that in Paper Money, short options will never be assigned early. That can happen in a live account. And both Scott and I have seen it happen. Both, in situations where we were doing the happy dance because it happened, and in situations where we were definitely not doing the happy dance, where, it wasn't a happy thing. So this class, is there anyone here that's new here for the very first time today? Because if you are brand new, I just want you to know we started the year with a $25,000 account. So we reset it to $25,000. This is our first time starting at $25,000. The last 5 years, we started at 20. Our max position size per trade, if we're buying a stock, is 5,000. And our max amount of risk per trade is 500, which is 2%. Now, would we have a 20% position size with $1 million account? On Thursdays, I teach a class called After the Close, and we started with $1 million. We pretended we inherited $1 million, and our max position size isn't 20%, it's 5%. And our max risk per trade isn't 2%, it's a third or half of 1%. So, these things are important to determine, but they also can change according to your account size. Our focus is on a short to intermediate term time frame, and we're trading both bullishly and bearishly. Yeah. Okay. So let's get out and, I want to mention one thing. So if you were in Atlanta, I so appreciate everybody that came up and introduced themselves. I was introduced to this world of trading at a live event, like, many of you attended in Atlanta this past weekend, back in 2011. And then I ended up coming to the other side of the camera in 2016 as a coach. So if you haven't been to a live event, they are free of charge to attend. You just have to get registered, and they are really, really popular. So they fill up fast. So if you live in the Phoenix area, you'll want to get signed up for the Scottsdale event sooner rather than later. I'm going to be at this event in Chicago in March and looking forward to, this is an advanced options workshop. So yeah, if you haven't been, I encourage you to check it out. You can just go to schwab.com/events. Okay, now let's get out to the platform. And I'm going to do a very quick overview of what's going on in the market. So when we look at the S&P 500, how would you characterize this trend? It's pretty hard to characterize it as anything other than uptrending, right? And this is a 9-month chart. Just let me find my cursor. But if we go out to the 1 year and then look at showing price as a percentage, this index is up 20% in the last 12 months. So we've seen a bit of consolidation here, really since the end of November. But, we did hit a new all-time high back here on January 24th. So still uptrending. Now, when we look at the NASDAQ, pretty similar, right? Like we look at, last 12 months up 21%. And we've seen some consolidation, but it broke. We had a diagonal resistance breakout, and then it looks like that breakout is now holding as support and moving again to the upside. And, you might not need a Patrick Mahomes type arm to be able to, throw and hit the all-time high, which was established back here, middle of December. It's certainly heading in that direction. How about the Dow? Kind of more of the same, right? Like here's our all-time high established at the beginning of December, and it came up to within a stone's throw of it, pulled back, and today we have this candle pattern, this Harami pattern, indicating that it might be bouncing off this support level. And if you're saying what support level, well, some might say, could that be a support level? It opened here and rallied, came down again, third time. And then what about the Russell? Again, we've got this, we're haramying, which means today's candle is totally inside the body of yesterday's candle. And, could this 100-day be acting as a support level? Well, some might argue that it hasn't been because it kind of blew through it here. But if we extend this diagonal line, it looks like that was acting as a ceiling, and then it broke out. Was it breakout? Turned out to be a fake out, broke out again. And this time, old resistance looks like it may be acting as new support. But this one, the furthest away from its all-time highs. And then what about the volatility index? Sitting at 16. So, that's kind of in the middle of the range where it's traded frequently in the last year. And then if we come and we look at the indexes, the S&P 500 sector indices, this is not new news. When we look at the last 3 months, communications, consumer discretionary, and financial still leading the pack, technology in fourth place. So consumer discretionary, communications hit a new all-time high last week. Consumer discretionary has been strong. When we look at this, on a 1 year, up 28% in the last year. Communications up over 33%. So super strong. And financials the same, up about 30%. Hit a new all-time high on Friday, that index. And technology, well, it's been kind of battered about, but still in the last year, leading the indices, right, up 23%. Okay, so having said all that, let's come and just look at a couple of positions that we have in our account. One is Dollar Tree, and we did an iron condor on Dollar Tree. It had been downtrending, gap down last September, and has been trading in this range ever since. And so we sold. I call this type of trade a credit spread sandwich. And why do I call it that? Well, because we did a short call vertical here. And the idea with a short call vertical is that we want it to stay below our 77 strike. And then we did a short put vertical here, and we want it to stay above the 65 strike. And so far, it's doing exactly what we were hoping it would do. We've got 11 days to go on this. So we're going to just let time continue to work its magic. So time decay. And this is where, when we're selling something, we want to sell it at a higher price and have the value go down, which is kind of counterintuitive if you're just starting out with all of this. But that one is just kind of going along according to plan. So that's that one. We also have on Internet of Things, or Samsara, we did a buy right covered call. So on this day here, we bought 100 shares of stock, and then we sold a covered call that expires on February 21st at 55. Now it's now trading above 55. So if it were in a live account, it is possible that we could be called out early, but we will not be called out early in a paper money account. So, and our goal in doing this was to be called out. That was our expectation. And so if we come and we look at this, well, here's Dollar Tree, the first one we looked at. And, we've got an 18% gain on that. And then with Internet Things, we're up about 4%. And what we want to look at here is our max gain would occur if we got called out at $55. We paid $51.37. So the most we can make is about $363. So far, we've made 215 of that. So we're just going to, continue to move along until this number reaches, something closer to the $55 mark. And then we might close it out. Okay, then we have two stocks with targets, Autodesk and AT&T. And if we have a quick look at those. So here is Autodesk. We bought it on this day, and it kind of went up and then kind of consolidated. Today we have, once again, this harami pattern, or a candle that's totally inside the body of yesterday's candle. Harami is the Japanese word for pregnant. So, and when this occurs at a potential support level, this is considered to be a bullish sign. So here's our target up here, and we're just going to let this one percolate. We can take this one ATR target off since it's already hit that. So this is our stock target, and on AT&T, we placed this trade just a few days ago, and here's our target based on a flag pattern. And so that's just kind of moving along and doing its thing. Okay. Okay. So we have already reviewed 4 trades. There's only one other trade I want to review, but let's go and look at something new. Okay. So how about we look at, well, let's look at Amazon. So Amazon is in this consumer discretionary field, right? And has consumer discretionary been strong? Yeah, it's been crushing it. And so if we look at this and we say, well, what do we see when we play I Spy on the charts? Well, we see something that has been uptrending. If we look at the last year, sorry, I zoned in, and so let me come back out. Here's a stock that's up, 34%. And then when we zone in, we can see that, this 30-day moving average has been acting largely as a support level. If it's gone below, it's kind of nicked below for a day or two and then come back up. And on Friday, it came down to this support level. We had a down day. And today we have this harami. It must be harami day in the markets. So, we've got a bullish pattern happening here. So could we, and I'm just going to change this back to a dollar value, could we look at something below the low of this day? And our low that day was 228. So could we come in and maybe sell like the 225 and do a short put vertical? And remember the short put vertical, if we adjust this, just so you see where the line is. So our goal here is for this to stay above 225. And as long as it stays above 225, we're good to go. We would likely have a profitable trade. And we have $6 worth of wiggle room if we can get enough premium for this, the juice to be worth the squeeze. So let's come out and see if that's a possibility. So if we came out 25 days, and why would we look at 25 days? Well, the idea of 25 days is that if we're in that 20 to 50 day time frame, if we're closer to the 20 days, we're going to have time decay at an accelerated rate. And so sometimes we can get enough premium and, sometimes we can't. But if we look at this, if we get $1.26, well, what's our rule of thumb? And we created an example trading plan. And so our rule of thumb, and I'm going to just bring this up, is that if we're in it for 25 days, we want at least a 25% return on our risk. And so if we're paid $1.26, how much are we risking? Well, $5 minus the $1.26. So we're risking $3.74. So if I take $1.26 and I divide it by $3.74, that's a 33.4, call it a 34% return on risk for a trade we'd be in for 25 days. So does that meet our criteria? It does. The other thing that we did in our example trading plan is that we said, okay, when we've got 80% of our max gain, we'd like to buy it back. So when this is worth about 25 cents, and I just took that 12 and multiplied it by 2, because if we put in a target of 12 cents, that would be 90%. And we could make it 90%. You can make it whatever you want. But, for our class, we said we're going to make this example exit when we've got 80% of our max gain. So we're going to come down here to good till cancel, confirm and send. And how much are we risking here? Well, we're risking $375. That's our theoretical max loss for the opportunity to make 124. And we're saying we don't even need to make the whole 124. If we can get out with about $100, we'd be happy campers. So base hit. We're looking with this strategy. It is not, a home run strategy. It's a base hit. And we're going to also look at doing, we're going to compare it to a long call vertical. So we're going to send that in. And there was a note at the bottom that said, hey, this is not a monthly expiration. And we know that. But with our example plan, it says, hey, does this trade 1 million shares a day or more? Check. Is the stock uptrending? Check. Is the sector uptrending? Check. Is the market uptrending? Check. Then for this strike, do we have a tight bid-ask spread? Is it less than 10%? Check. Do we have at least 20 times the number of contracts we want to trade? Check. So it's checked, the first 6 or 8 boxes on our example trading plan. This is open interest, number of contracts that were on the books when the market opened today. This is volume, number of contracts traded today. Okay, so that's the first one. Well, if we come back and we look at the chart and we say, okay, this is where we put our short put vertical. And our strikes were 225 and 220. And it expires, I think that was March 7th, right? Okay. So we're going to, okay, where did my cursor go? Cursor. On the right. Here we go. I don't know why my, sorry. There we go. My cursor decided to play hide and seek. Okay, so there's the first one. And we've got some wiggle room. Now, if we're bullish on this stock and it's in a bullish sector and the market overall has been bullish, could we do a long call vertical? Now, what's the difference? Well, the difference is it's a little more directional. So if we bought the 231 and then funded that by selling the 235, it has to go up by $4, well, $3.50 a share, and then stay there, in order to get our max gain. So let's look at that. So if we come over here, and we could come out 3 weeks. So here's our 230, which is the first strike in the money. And then the 235, it would cost us 255. And our example trading plan for this one, we say we want a 50% gain. So we'd want to get out at about 375, 380. If I take 255 and multiply it by 1.5, well, it would be 382. And so how many of these could we do? Well, we could do 2 and we'd be risking 510. So first trigger sequence, right click, opposite order, say, hey, when this is worth 382, you might say, well, isn't your max gain if it hits $5? Yes, it is. So if you're bullish, why get out at 382? Because we don't want to be greedy. And if we want that entire max gain, then we have to wait until pretty close to expiration. So we did a trade on Netflix last Monday, and we actually did 2 trades. We were going to compare them, and we were only in each trade a day because it went up, and right after the market opened, there was some volatility that worked in our favor, and we ended up out of the trade for our 50% gain. If we were waiting for the whole enchilada, chances are we would still be in that trade, and it would be tying up that capital. So here, the most we can lose, $500. We're aware of that. And how much can we make? $494. But we're saying, hey, if we could make like 250 of that 500, half of it, we'd be happy. And so now if I compare that to the short put vertical, with the short put vertical, our potential return on risk isn't, 50%, it's about 30%. And we're saying, we're willing to get out when we've got 80% of our max gain. We might end up with a 20% return on our risk. But the probability of achieving that is likely higher. So we're going to compare this to the short put vertical. Now, some of you may be saying, so why did you pick this strike? This expiration date, rather, 7th of March, when you've got hundreds versus thousands. And that's a good question. Well, if it gaps up, we might get out of the one with the closer expiration date faster. And then again, we might not. And if we look at this, 230, 235, which I did before the class started, the price is very similar, 260. We were at 255 on the other one. So the other one was only a nickel cheaper, and we really want the same thing to happen. So the advantage of going out further is that if this pulls back, we'd have more time to recover. So we might do another example. Okay. Yeah. We talked about in Atlanta that staying in to get, the last scrumpy bit of profit you can possibly get. And I talked about how that cost me $3,500. I may tell you that story someday, but today is not going to be the day. Okay. But I will tee that up for another day. Let's look at another example. So let's come to the Goog, or Google, as I affectionately call this one. So, if we're playing I Spy, which is one of my favorite technical analysis things to do, what did we see on the chart here? Well, we saw, some might say, a sloppy inverted head and shoulders, or kind of a nice crisp cup and handle, a cup and a handle, right? And then it broke out, which is what we're looking for. And how much of a range did we have? From about 150 to 180. So about, and this is just a thumbnail, about a 30-point range. So that would say, what might a target be? Maybe around the 210-ish level. And it came up, and then what did it start doing? It started going sideways. So it came down, and it's been trading kind of in this range. And then Friday, it came down, had a big down day, but ended up right where it's ended up several times before. And then today, what do we have? Our candle pattern of the day today. We have this Harami pattern. So could we do, yes. So Salient Joe is saying, yeah, we're testing previous support. And yes, we did that. And today it's bouncing, and this candle pattern at a support level is considered to be a bullish configuration. So could we come in here and sell something at that 185 or below? Well, let's see. So let's come to our trade tab. And if we look at the 185 again, and again, I'll show you where these example trading plans are. But, the question is the market uptrending? Yes. Is the communication sector, which this is part of, uptrending? Yes. Is the stock uptrending or bouncing off a support level? Yes. Okay. Or you could say it's bouncing, it's been going sideways, but it's bouncing off a support level. And then when we come out here and we're saying, okay, this 185, do we have a 10% or less bid-ask spread? Well, it's 20 cents, so check. Do we have at least 20 times the number of contracts we're thinking of trading? Check. So it kind of checks a number of boxes. Okay, so then let's say, well, next question is the juice worth the squeeze? So so here we get $1.77 for a $5 wide spread. And so if you say, okay, that's what, 324, that's about 50%, right? 176 divided by 324. Not that I'm a mathematical genius. That comes out to 54%. And so you could look at that and then say, well, I'm buying close to support, so I'm willing to take this risk, because since this gapped up on December 11th, it hasn't closed below 185. So that's almost 2 months. So we're going to go ahead with that. We're going to do one contract because we're risking over $300. So we can only do one contract, single order, first trigger sequence. And we're going to say, okay, right click, opposite order. When this is worth about 37 cents, we're going to buy it back. And how did I get 37? I just took $1.85 times 0.2. So that's 36 plus 137. Confirm and send. So how much am I risking? $317. How much could I make? Up to, oh, this is now saying it's 183. Yeah, so, we may have to adjust this. And we're saying, if we make 150, we're going to be happy, or somewhere in that neighborhood, base hit. All of these are base hits. And then we're going to all right. So sorry, guys. I lost you there for a second, but we are now back. And it was the weirdest thing because Google, the Thinkorswim just sent me a note and said, yeah, that last order you put in, it didn't go through. There was an issue. So we're going to do this again. So we're selling a vertical, 179. We already know that meets our criteria. First trigger sequence, right click, opposite order. We're going to make this 35. When it's worth about 35 cents, we want to buy it back. Good till canceled, confirm and send. We're putting this in our short put vertical group. And how much could we lose? 321. That's our theoretical max loss, max profit 179. And we're going to compare this to a long call vertical. And again, we've chosen a weekly. Now, if we come over here and we say, okay, so here's our short put vertical. If we want to just show this on the chart, we'll make that 175. And this is our short put vertical at 185 and 180. And it's March 7th. So could we kind of do one at maybe 185, 190? Like, when you look at the high of this day on Friday, it opened at 191. So, if it goes up anywhere close to the top of this range, a long call vertical might be in a nice profitable range, right? So let's look at that. So could we come out here and do the 185, 190? Or might we say, we might want to give ourselves a little more time. So on this one, we're going to buy a vertical. And how much is it? 243. So if I take 243 and I multiply that by 1.5, so that would be 364. So we're just going to do one contract because I'm going to do two example trades here, and then we're going to compare all three of them. So this is first trigger sequence, right click, opposite order, and we're going to make this 364. So 240, 360 times 1.5. Good till cancel. Confirm and send. And we're going to put this in our long call vertical group. Okay, we know this is a non-standard expiration and we're paying $240 to get in. Now, what if we looked at exactly the same strikes and we came out to March 21st? Now we've got a lot more volume here. Our bid-ask spread is about the same, 15 cents. It's still 15, well, here it's 10 to 15. But it gives us more time so that if it doesn't quite go according to plan, then we have a little more time to recover. And so some might appreciate having that extra time. Now, what's the downside? The downside can be that if we have that volatility early in the morning when the market first opens, we might have an opportunity to get, it hit our target and us to get out. And might that, work, as effectively in the longer time frame? Well, it did for us last week with Netflix, but who knows what will happen this time. So we're going to compare and contrast the two different time frames, and we're just going to do one of these. So it's at 248. So we're going to make this one 375 is going to be our exit. So 50% higher. And we'll just see how these three trades work out. So that's our long call vertical. And we're going to compare to the short put vertical and the March 7th long call vertical. And sometimes I do these comparisons in class, and then sometimes I do these in a trade management mini session. There should be sound, so please hit your refresh button if you're not getting sound, Leon. Okay. So let's go and look at where you can find these. So, oops. Let's come out. So here are the trade management mini sessions. I did already put this in the chat, but I'll put a link in again. So here it is. If you're watching this in the archives, it will be in a tab at the very end of the webcast. It will also be down in the show notes, so you'll have access to this. If you haven't watched these 2 10-minute sessions on the power of compounding, I'd say please watch them, put a comment in and let me know what you thought of them. And I'd say, like, share them with your kids, your neighbors, your brothers and sisters, your family. It's basic stuff, but man, it's powerful. So here are the example trading plans. And today we've talked long call verticals and then short put verticals. So here are the example trading plans, and they're just examples. So you can go and look at these and then tweak them, however you like, but it's just a framework to get you started. We also did a quick review on a buy right covered call that we did, and here is the trading plan for that. And then when we do multiple trades like this, I cannot put, reviewing Google in the thumbnail. But as soon as I start the webcast, I'll say, we did 3 trades. Here was the example stock that we used. And so sometimes I will put them in here, and then I'll let you know in class when I'm doing that. And then if you are new, down at the bottom, there's a whole series of quick and easy, most of them are around 10 minutes long, how to customize your monitor tab or a watch list or add scripts, how to customize the option chain or a chart, all that kind of stuff. So it's just a handy resource. So for a replay of today's webcast, I think Scott has already posted that. But if you come to Trader Talks, and I encourage you to not only come to Trader Talks, but then subscribe. And if you're with me live or watching this in the archive, there will be a button in the bottom right corner. Just hit that button and you've subscribed. And when you first get there, what it'll show you is what's currently playing or what's up next. But if you come to playlists, and then you just want to scroll down and look for, trading a smaller account. And then you'll have the whole playlist. Okay. Now, somebody else had said that they, were kind of brushing up on their option strategies. So there's a start here, options, basics, and strategies. And if you look at this playlist, it's 1 through 12. And we cover 10 different strategies. So instead of, binge, watching Netflix, you could be doing some binge learning. And then when if you scroll down, you'll find the trading a smaller account. Today's session will be posted at the very top. Okay. There's also a survey that's been posted in the chat by Scott. So here's my ask. If you will click on that link, there's 2 questions. It ranks from 1, I hated this, to 10, I loved it, and everything in between. And so, if you'll take just 10 seconds to do that, there's also the ability to put comments in. So my promise to you is that if you fill it out, I promise to read each and every comment, and Scott will as well. So you have a voice, and please, we encourage you to use it. The other thing is that if you're watching this in the archives, as the majority of people do, you can easily just put a comment in, and I read and respond to those on a daily basis, except on the weekends. And then I get to all of those on Monday. Now, and then last, I want you to hit the like button, because by hitting the like button, it helps move this up in the algorithms so that you can, so that more people can find this content. So you could be doing a favor for a random stranger who you may never meet, just by hitting the like button, so you could check off your good deed for the day. It also lets Scott and I know that you found this content valuable. Now, with long call verticals and short put verticals, we look at these daily. So here's our short put verticals. We have some that we've just put in, like our trade on Google. And then we have all of these. And are any of them close to 80% up? No. But we do have one, American Express, that is 83% down. Like, yikes, it was profitable on Friday and today it's not. So we might want to go have a quick look at that. So if we look at American Express, let me do that again, AXP. So here's our trade. We did a short put vertical. It expires February 21st, and the strikes are at 310 and 307. And it's just in the money by just a smidge. But it's come down to a support level that it has hit multiple times, right? Once, twice, 3 times. This is the 4th time. So as long as this support level holds, we're going to take one hand and the other hand and then sit on them. We're just going to let that percolate. Okay, so even though that's, a big fat red candle, maybe tomorrow we see a Harami pattern, maybe we don't. If it breaks below support, we may choose to exit. Okay, so that's that one. Okay, now let's come up, and all the rest, we're just going to leave. Okay, American Express, this one was down more. It's rallied, off its low for today. And then the long call verticals, we're going to look at these every day and say, is anything either up close to 50% or down close to 50%? Now, Marvell is at 82%, but Marvell was one of those that got hit with that extraordinary news coming out of China. And, it was just clipping along, going tickety-boo. And then all of a sudden it got hammered. And then it started to rally, and it was rallying so nicely. We position sized appropriately. We had this bearish engulfing on Friday, which is kind of annoying. But today we've got this Harami. And so we still have 2 weeks for this one. So we're going to just let it continue to percolate and see if we can't either, narrow that loss, or maybe eliminate that loss by the 21st. So stay tuned. We'll look at this one again on Friday. And the rest are all, just kind of clipping along. So we did our trades on Google and Amazon. Just to review, one of the people I met in Atlanta said that they found this very helpful. So we did 2 trades on Google, and then, we did 2 long call verticals, and then we did a short put vertical on Google as well. And I'll make sure that fills. And then we did both a short put vertical on Amazon and a long call vertical on Amazon. And I will make sure that one fills as well. Now, what we didn't get to was the flit of next, Netflix, which if we look at that, is continuing to uptrend. Some other ones we may want to keep on our radar our BA Boeing, which had this big inverted head and shoulders pattern and then broke out and broke out again. But today it's pulling back. So what are we going to do? We're going to wait and make sure that it's a true breakout and not a fake out. We might want to keep our eyes on Goldman Sachs as well, pulling back today, but could we wait? So, you know, this is one we might look at and getting started with technical analysis tomorrow. So guys, thank you so much for joining me. Always a pleasure to see so many of you here. Huge thanks to Scott Thompson. You guys kept him super busy. Thanks for being here for that. Hit like, subscribe to the channel, fill out the survey. I know I get to be a bit of a bossy britches right at the end here. And then don't forget to follow us on Twitter, Scott Thompson CS and Barb Armstrong CS. Up next is trading technicals, something along that line. James Boyd's class, you won't want to miss it. Stay tuned, folks. We'll see you in a webcast coming up soon. Bye for now.